Steve, I'm interested you say that as not much has happened yet in Asia. Is that something that's the nature of the Asian market, or because they haven't been hit as badly yet by the financial crisis?
Well, it's really on, if you like, on both the supply and demand side, if we use those economic terms. And what we've talked about so far is really the drivers of claims costs and litigation. Of course, what we're also seeing is a contraction of capacity in the insurance industry. In balance sheets, insurers' balance sheets are impacted, same as everybody else's. Investment returns are, of course, very low, so that puts pressure on insurers' ability to offer all kinds of insurance, D&O and other lines, and that is a contraction in supply. That is less so in Asia, because the longer-term aspiration of many Western and American, European and American companies, of course, is to build larger presences in Asia. So there's a willingness to get into that market right now. So there's more supply there than perhaps we're seeing in New York and London.
And there's been a lot of talk about having a sort of introducing a class action system in Europe as well. Do you feel that this is going to happen? Do you feel that this current crisis is going to make this more likely, Kim?
I think the current crisis could precipitate that. The private litigants are having more access to the courts in Europe already. The plaintiff securities bar in the United States is very, very organized, and they've been cultivating the European market for quite some time now. They've been trying to cultivate the European institutional investors for the day when they can start to bring those actions in Europe. Then now, all of a sudden, you have these huge losses. These are losses that are being huge losses of wealth being experienced by executives, employees, and pensioners. So it's an ideal environment to foster the development of private securities litigation on the continent.
And I'd have a question on regulation. I mean, we've seen some very strong statements by leading politicians in the UK, referring to the court of public opinion around contract law for remuneration of certain senior executives. I mean, do you think the strength of the regulatory pushback is going to be a strong angle for the plaintiffs' bar to leverage?
Well, they've definitely done that in the United States. In the United States, I think the statistics show that whenever there's a class action in a case in which the Securities Exchange Commission or the Department of Justice is involved in an investigation, the settlements in those cases tend to be much higher.
I guess that the politicians can't resist getting stuck into some of these things. I mean, a lot of these issues are going to come down in the end to corporate governance as well, aren't they? That there's a strong feeling that financial institutions in particular paid people to take too big risks. There was no downside for the people who took those risks. They weren't properly monitored and so on. Do you see trends in this area?
For sure. And right now we can see the banks deleveraging very rapidly, de-risking their balance sheets and starting to look at their own internal governance procedures. And we see, of course, lots of debate coming out of the G20 and other areas, and coming out of Brussels on how we should approach regulation. I think it's going to take some time. I think mostly a more connected and more globally collaborative approach to regulation. I think everyone would agree with that, but getting from theory to practice is going to be 2 or 3 or maybe more years. And then if we look back to Sarbanes-Oxley, what impact did that have on the class actions and litigation? That really wasn't favourable. The plaintiff's bar seems to be able to push on forward regardless.
Yes.
Well, of course, in the U.S., Enron and WorldCom led to the passage of Sarbanes-Oxley in 2002. And, of course, in light of the crisis we're in now, there's going to be some sort of regulatory reform. I think that initially it's going to be led by the U.S. and the U.K. because of the SEC and the FSA, but of course I think there's going to be a more global effort because of the interconnection of the markets. It'll be interesting to see what the reforms might be. I would anticipate there's going to be more transparency. There's going to be less leverage, more capital requirements, or more reserve requirements. I think there's going to be a greater effort to align executive compensation and compensation of highly compensated individuals with risk management of the corporation. And I think there'll be efforts to eliminate real or perceived conflicts of interest And one, of course, that comes to mind would be the rating agencies.
Yeah. Well, let's come back to those issues, because we've got a question in from a viewer now, which is, do you see a larger impact on dedicated side A D&O programs as a result of the financial crisis?
Well, the answer to that is yes, and just to avoid a bit of the jargon here, so Side A cover is provided for when a company cannot indemnify its director or is unable to pay the claim. And so the latter is really the situation here, with an increase in significant increase in bankruptcies. That's going to mean a lot of companies aren't able to pay out, and that kicks into then the Side A cover. And this is especially important for retired directors, retired independent directors, and so the extent of cover once you're not acting on that board is something that they need to fully understand.
And on your side of the Atlantic, Kim?
Well, this is the first year in handling these types of matters that I've seen the ramifications on Side A coverage. I can think of 3 or 4 matters off the top of my head in which we're involved, in which Side A coverage has been implicated because of the insolvency or bankruptcy of the companies. And it's very real and has the potential to roll out and not just involve, mortgage originators or financial institutions, but it could, God only knows, automobile companies, who knows where this might end.
Kim, there's another question just come in from Robert Harrison, who asks, given the explosion in US, European and Australian class action, what similar activity, if any, in Canada?
Not as familiar with Canada, but I think the Canadian system's very similar it's a sort of a hybrid between what's happening in England and what's happening in the US. I know the last several years there were been some big cases in Canada. I recall there was a big settlement involving the investment bank with respect to Enron. So I think that I think it'll be somewhere between the U.S. and the U.K., but there's definitely the same sort of exposures there. In fact, it's going to be interesting because I think we're talking about industry sectors. I've read a lot of articles that suggest that companies that are in industry sectors that are commodity-driven would be very much impacted by the current financial crisis. And, of course, there are a lot of commodity-driven businesses in Canada.
Sure. Just to go back to a point you were making, Steve, about executive pay and risk management and so on, that sort of suggests perhaps that you as underwriters will also have to pay a lot more attention to these issues now. Are you changing the way you approach these sorts of situations?
There is a bit of a change in emphasis, but what I think I would say is that we already looked very much at the quality of management and the culture of management in our customer base. Now, first and foremost, we try and understand as best we can the financials, and particularly the balance sheet, and that's even more important now with the liquidity crisis. But quality of management, risk management, culture, strong corporate governance are all the areas that an underwriter will look for in terms of the underwriting process.
But of course, one of the difficulties with the current crisis was nobody quite understood the combination of factors that made the risk so great as well. So, in a sense, you must have to evolve as you go along.
We do, and more transparency helps, and with better regulation, I think that is coming. It's a little bit confusing right now with mark to market, which has come in, and now certainly the US accounting board is stepping back a little bit from that. There's some fascinating arguments there about the pro-cyclical nature of it, and is it a good thing or is it a bad thing? But we do need to have the transparency, both for investors and for underwriters.
There's, I think, another factor. I think a lot of, there's a tendency to think that because financing's dried up, deals won't be done. But of course, there was just 3 big deals announced recently, one of which Oracle taking over Sun. So cash-rich companies still have the potential to do deals, and in particular to buy distressed companies. So there could be more merger and acquisition activity by the powerful. Conversely, there's some speculation that private equity companies need to move some debt off of their balance sheets, and as a consequence, there might be more IPOs driven by the private equity companies. Now, what's interesting about this is, historically, mergers and acquisitions and initial public offerings have been a fertile field for the plaintiffs' bar.